Hello traders, Gary Wagner here just before 10 o'clock in Honolulu, 4 o'clock in New York. It is Thursday, 4th day of June 2015, and this is the daily report for gold and silver. We've got the commodity index, equity index, pretty much everything but the VIX across the board trading lower on the day. Precious metals obviously part of that equation. Gold currently trading off about $8 on the day, $1176.50. We have seen a low of $72.40 and a high today of $86.60. Silver also moving down about 33 cents, $16.15. It's had a low of 08 and a high of $16.50. Of course, we did add silver to our short side equation. Traders who took that call are short roughly at $16.50. We will talk about various exit strategies on these trades, as well as our strategy for trailing stops, all on today's daily report. So traders, all of our subscribers at this point should be short, whether you took the aggressive call 2 days ago or entered silver yesterday, or the conservative sell on silver, which was yesterday. All of those positions are now showing profits. I want to start today's show by taking a look at our short-term 4-hour charts. These, of course, are Japanese average charts. And when we look at these charts, the first thing that we want to point out is you're not going to get a really good read about candle size the way that you will when you go to larger cycles like dailies with the Japanese average. But you've got solid red all the way down, really solid red ever since the market broke from about 92, and that's really our first entry point. That's where the aggressive sell signal came in a couple of dollars ago, but just after it broke through 1200. Now, in terms of our current Elliott wave count, we're going to go through a couple of them, but on a very, very short-term basis, we've now entered and I have been really ingrained in this fifth wave down. On this fifth wave down, we're looking to see how low it could go in terms of where we might find some support and get that counter up wave. But that's, of course, on a very, very short-term basis. The other thing is if we look at the MACD, let me go ahead and blow that up a little bit for you. And again, these are very, very short-term moves. But we talked about these false positives that we got, and you can see this false positive right in here. Market comes back up, but now look at how the momentum is really shifted to the downside over today. We've got absolutely a very nice cross, so I think we could see this market sell off a little bit before we get any kind of counter trend to the upside. So the real $64,000 question, and I believe that we'll see some sort of response or a little bit more data that will clarify which way we might see the market go. I turn to this chart, it's 720-minute chart. When we look at this chart, as you know, I've had a basic fib retracement in this market, which is really illustrated concrete resistance levels. This was up at about 1221, and absolute support levels, and this one's around 72. Now, the interesting thing, when we look at today's low, it comes right to 72, and so that is a reason that we really want to watch this at this point. We'll probably trail our stops either this afternoon or tomorrow morning. Specifically, we have the jobs report coming out, and anything can happen at that point. But you can see that it came right to this support level, and this is a very, very strong support level. So here's the key, traders. If it breaks through this particular level, my sense is that it really has nowhere to go longer term but 1140, because that's our next major stop for any kind of support. When we look at the market, that is this large third wave down, the conclusion of it, and of course our fourth wave up, that counter wave, is a wave that took us to these highs at around 1231. So the key on something like this is, as we look at this fifth wave developing, realize that what we're looking here is the counter or the smaller count found within that. So we could in fact see the market find some sort of support here, bounce back up a little bit, that counter wave, before returning and moving back lower. Because theoretically speaking, according to this model, if in fact it unfolds with a true fifth wave, we will in fact breach this low, because wave 5 is going to have a lower low than wave 3. The next thing that we can do is actually take a look at wave 1, and what that will do is give us a benchmark of size, and we can kind of extrapolate that wave 1 and wave 5 are many times equal, and in that way what we can do is get a better sense for where we might see this market move. However, we do have an issue with using that wave 1 benchmark that I spoke about, and I draw your attention to this daily chart. You can see this is really counting wave 1 as a very, very short wave on this particular methodology of running our Elliott wave scenario. So in that case, we're about equal now, but that really won't work because we do know that wave 3's low and the wave 5 low really has to be below. Otherwise, it's labeled a truncated fifth wave, but that's not really what I'm looking at. MACD on the daily charts, we absolutely got our cross. We're still in sell mode. Stochastic's a little bit different though. It's definitely in oversold territory. And in fact, I had a question that came in from one of our subscribers who talked about isn't it unwise selling the market when stochastics are so low? And the key with stochastics, and the way I try to explain it, is that unlike many other technical studies, what a stochastic is doing is comparing the current close to the highest high over a period of time and the lowest low over a period of time. So when the closing price is near the highest high of that time, you get a reading of 80 to 100%, depending on how close it is to the high. 20 to 0 simply means that you're closing near the lows of the day. That being said, when you have a marketplace that is moving down, you're consistently having the close be near the lows. So you'll get the market remaining extremely oversold for long periods of time, and so it's not the best indicator to use alone. When coupled with other indicators, it tends to have better results. Now, let's talk about exit strategies and what we're looking for. Well, the first thing we're probably going to want to do is go in and trail stops. We're trading at 76. Your stop right now is sitting at around 1202. The issue that I have with trailing stops this close is that the first logical place is about 1195. That's really tight. That's about $2 from where we got into the market. You can go ahead and do that. That, in essence, will lock in any kind of a potential loss and allow you to maintain or take advantage of any moves that come down. So my suggestion on gold, if you do want to trail your stop down, what you really want to do is move it to 1195, call it, on a trailing stop. You're in at 92.50, so you've just reduced any kind of exposure to the market considerably. And now, if the market continues to run in our favor, of course, we're going to be able to maximize profits, but we've limited the loss side of that. So traders, go ahead and trail that up. I'll put that out on today's show as a trade alert. So traders, what about silver? Well, first of all, I think in hindsight, it was a good decision yesterday to really add silver to our mix of short positions, meaning adding it to our short gold. Daily chart right now that we're looking at, continuous contract, COMEX silver. Most interesting is this break well and hard below the channel right now. It is currently trading at around 1612. You're in at around 1650. In terms of trailing a stop up, the only thing that really makes sense here is you've got the high today at around 1650. So what you can do is you can trail your stop in silver to protect your equity to, call it 1660 or 1655. And in that way, regardless of how this market moves, when the job report comes out, you're not going to take a loss. Now, what's the caveat? There's always a caveat to these things. The caveat is during days in which big numbers are released, you tend to get these wild gyrations, whipsaws in the market as traders adjust and react to the news. And so you can have a market that will, for example, in silver, that'll spike up to 670 and then start selling off hard. Not that that's going to happen tomorrow, but you get this increased amount of volatility that enters the market when Fed minutes are released or job report. Those are really the big issues. And we'll have to see what happens. But I will tell you this. I think we're on the right side of the fence, but I want to protect us if we're wrong. We'll talk about exit strategies tomorrow in terms of the profit side. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.